Alright, so investment banks pay their employees a lot of money because investment banks make a lot of money. But how exactly do investment banks make that money? That's what we're going to be talking about today. What's going on, people? Today we're talking about how investment banks make money, because a lot of you are applying to investment banks for internships, grad schemes, spring weeks, etc. And you kind of know, or you might not know, what divisions you want to go and work in, but not many of you actually know how investment banks make money. So in today's video we're going to talk about the different divisions and how each of them kind of makes or generates revenue for the investment bank as a whole. So without any further ado, let's get straight into it. Alright, so when we think of investment banks, it's very important to understand the different or the distinctions between the front office and the back office. The front office and the back office consist of different divisions. The back office consists of things like human resources, technology, finance, audit, tax, so on and so forth. And the front office consists of the investment banking division, sales and trading, asset management, etc. So the front office, the key distinction here, and I've done a video on this, you could find it on the channel. The key distinction is the front office is the revenue generating part of an investment bank, and the back office isn't revenue generating, but the back office is super important because it allows the front office to do their job as efficiently and effectively as possible. So if you're looking to be in a client-facing role where you are bringing in money to the investment bank, the front office is where you want to be. The front office is mainly making revenues for the investment bank by charging fees. Fees for what? Fees for advice and expertise, fees for making things happen, fees for giving clients access to specific investment vehicles that they otherwise might not be able to access. You've also got fees for managing money or capital. You've got fees for creating or structuring a product. So there's a number of different ways that the investment bank, the front office of the investment bank, is generating fees and revenues. And so let's kind of dig a little deeper into the different divisions and specifically how they generate that revenue. All right, so let's start with the asset management and the private wealth management or private banking businesses. So typically they are going to charge fees for the money that they are managing. So when you are in asset management, for example, you will have assets under management or assets under supervision. So what this means is clients have money, they give it to you as an asset manager or private banker, and you're responsible for investing that into the financial markets. Now, on the capital invested, you're going to charge a very small percentage, a very small fee. In asset management, it's like 0.1% or 0.5% on whatever the sum is. It would vary typically. The larger the sum, the smaller the percentage, but a small percentage on a large sum is actually a lot of money. So in asset management and in private banking, you're charging fees on managing money. So that's how you generate your revenue. Now that's a management fee, it's very small. And then you've got a bigger fee, so this is called the performance fee. So sometimes, and this is typically the case for alternative products, when you're investing client money into hedge funds or private equity vehicles, you can expect a performance fee. Now what this performance fee says is basically, if you can reach this target, whatever that target might be, you can get 20% of the profits from that return. So it incentivizes the portfolio managers or the asset manager who is investing the money, or the team of asset managers or the team of investors investing that money, to kind of try their best to hit that given return target so that they can get that performance fee, which makes everyone happy because it means more money in your pocket. So in asset management, private banking, you've got the management fee and you've got the performance fee, and that's predominantly how they generate revenue. Next, we've got consumer banking. So some banks that you may know of, like JP Morgan, they've got Chase. Goldman Sachs recently entered the market with Marcus a few years ago, and these parts of the businesses are basically parts of the investment bank that serve you and I, the general public. So if you or I want to go take out a loan or a mortgage, we're going to pay interest on that. So those interest payments we are giving to the bank, that's how they generate revenue from the consumer banking business. So they generate revenue from tons of interest payments from consumers or customers like you and I. And also they sell different types of financial products to the general public, and that's how they make their money. So commissions and interest payments. If you're interested in breaking into the world of finance, banking and investing, then listen up, because you can get a massive 80% off a ton of relevant online courses. Udemy, who are also sponsoring this video, is the leading global marketplace for teaching and learning with over 52 million students globally. They've got over 196,000 best-in-class courses in over 75 languages covering finance, investment banking, asset management, digital marketing, career development, and so much more. Best of all, you can use Udemy to learn at your own pace, in your own time, and on your own terms. If you've got a dream of breaking into the world of banking, finance, consulting, etc., you can start learning your way toward it by using Udemy. Not only does it allow you to expand your potential, but you can be sure you're getting access to high quality resources and courses simply by exploring the ratings and reviews on each course. Udemy currently has a massive sale going on, which means you can get courses on just about anything for up to 80% off between the 17th of May and the 25th of May 2022. Personally, I think you'd like some of these courses. The Ultimate Guide to Personal Finance and Saving Thousands, the Complete Investment Banking Course 2022, Multifamily Development Finance and Asset Management, the Complete Finance Manager Course 2022, the Complete Financial Analyst Course 2022, Successful Dream Job Search 2022 and live teaching classes, Get Your Dream Job, Interview Techniques and Resume Writing. I've personally been using Udemy to learn design, digital marketing, and visual development for about a year or two. I've linked all the courses that I've mentioned in the video description down below, so do explore them if they're of interest to you. Alternatively, you can click one of those links and then browse the platform to see if there's any other courses that might be more relevant to you and your current situation. With that, let's get back to the video. Alright, so we've done asset management and private banking, we've done consumer banking, next we've got sales and trading, and then we'll end on IBD, investment banking. So sales and trading is essentially, a marketplace, right? So on the trading floor, you've got salespeople, you've got traders, you've got structurers, you've got researchers, and you've got their clients, right? Let's say they've got a client here who wants to buy, I don't know, $100 million of gold or a given currency or a commodity or some sort of financial security. They want to buy it, right? Then on the other end, you've got a client who wants to sell that commodity or financial security or product that this client wants. The sales and trading person or the trader or the salesperson, they're in the middle, right? They're in a position where they can create that market. That's why it's called market making. They're in a position where they can connect this buyer with this seller in order to make that transaction happen. That's what they do. They make that transaction happen and they take a small cut, a small percentage as a fee or a commission for making that happen. So on the sales and trading floor, you're predominantly making money by market making. You're taking a small slice, which is a fee, from each transaction. Other ways you can generate money or generate profits or revenues in the sales and trading floor, there's tons. One way is arbitrage. Arbitrage is basically where a trader is going to be buying and selling the same security in different markets. So they might buy gold in Asia and sell it in Europe for a profit because the different markets, different time zones, whatever it might be, have different prices. So they're taking advantage of different prices in different markets. You could do the same for currencies, so on and so forth. Last but not least, we've got the investment banking division. So the investment banking division is typically advising companies on how to raise money through the debt markets. So raise money with debt financing, raise money through the equity markets, so equity financing, advising companies on how to go public, advising companies on how to take over other companies or merge with companies, etc., etc. And so because they have all this expertise and knowledge, they are going to charge or make money by giving advice. So that's why they make money through advisory services. Because they're giving this advice that their clients don't have any expertise on, they're able to charge a fee for that. Prime example, Elon Musk wants to buy Twitter. They need a ton of investment banks to kind of advise on the transaction. The investment bankers will take a small fee from the whole transaction, and that fee is determined by the size of the transaction, as well as many other varying factors which are too niche to go down into. But also, they're going to be responsible for providing the financing for Elon Musk to take over Twitter. So there's revenue that they can generate from providing financing as well. And that will vary based on equity financing or debt financing. If it's debt financing, there'll be interest payments that they get. So, if someone takes out a loan, you need to pay interest on that. So the investment banking division will be responsible for structuring that product or creating the relevant loan that is needed by the client. They'll charge a fee, they'll get interest. So there's lots of different ways that they can make money. All right, so that's all of the front office divisions, the revenue generating businesses of the investment bank. And then you've obviously got the middle office and the back office, which might interact with clients of their own, but they aren't responsible for bringing revenues into the investment bank. And so how do they kind of survive, you might be wondering. So all of the revenues that are generated by the investment bank typically cover the costs of running the investment bank. So the front office might generate revenues, but a lot of that money is going to be used to pay the costs, the salaries, the bonuses for all of the divisions throughout the investment bank. Now, one thing to note, investment banks are very smart. So each division, right, asset management, private banking, sales and trading, investment banking, consumer banking, whatever, they're all very entrepreneurial. They have tons of different ways of making money from their clients, right? So they all sit inside an investment bank. Now, the investment bank is very good at making money. However, let's say 1 year the sales and trading business does really poorly, it generates really poor revenues or even negative, right? But that year the asset management business might do really well, and vice versa, or the investment banking division might do poorly and the consumer banking business might do well. And so the smart thing about investment banks that have different divisions, especially the big global investment banks, is some years some of the divisions in the front office might not perform as well as the others, but they're kind of hedged and protected by the other businesses doing well. And so the investment banks are smart because they've kind of diversified their revenue streams, which means, year on year, they're likely going to be profitable for the most part, which is very smart. And so year on year, most investment banks are making money because of their diversified streams of income. If you want to learn more about any of the investment banking divisions, check out some of these videos, and I will see you in the next one. Peace.